Hello, everybody, and welcome into Commodity Culture, where we break down the commodities sector with the goal of making you a better investor in the space. Before we dive in today's standard disclaimer, nothing here is investment advice. Do your own due diligence. Today is March 17th, 2026, and my guest is the CEO of CanCambria Energy, a company aiming to commercialize their flagship asset, the 100% owned Kiskunhalas project in southern Hungary, a significant gas condensate resource in the heart of Europe. It's Paul Clarke. Great to have you on the show.
Hey, Jesse. Great to be here. Appreciate the time to share a little bit about our company and our plans in Hungary.
Yes, I'm excited to dive into that. Before we do get there, I want to talk about, of course, some timely news, which is the oil and gas sector. The war in Iran has escalated. The Strait of Hormuz remains closed, and oil refineries and infrastructure have been bombed. We're currently sitting at around a $95 a barrel WTI price. What does this all mean for the energy space, and how seriously do you think this could continue to affect prices?
Yeah, good introduction. Very timely. I would say significantly. There's a huge amount of uncertainty, a very dynamic situation over in the Gulf there. We certainly didn't anticipate prices moving the way that they have as we started to explore 2026 and quite where it goes. We're watching, as I'm sure most of your investors and other folks across the region are looking to see where this goes. Clearly, it's going to run several weeks and into months. Hopefully, it wraps up here sooner rather than later. But absolutely, some very significant impacts on commodity prices. We are, naturally we're focused on natural gas in Hungary in Europe. So we watch natural gas prices. They popped almost immediately. There's no buffer there. There's no strategic reserves of natural gas, more of a local commodity. And of course, natural gas jumped in the region of 60% almost overnight once there was a realization that LNG was impacted through Qatar, Europe, and we'll get into this as a huge reliance on LNG. Shortly thereafter, oil follows, and we see oil in that $100 region as the straits are closed. We've looked at a number of investment reports here, and there's certainly visibility into $150 oil over the next several months if there's not a fairly significant resolution. It will take time, even if there was a resolution almost immediately, to unfold some of the supply side issues. It takes a couple of weeks for LNG to get back up and running. Even the petroleum reserves, the drawdown there from the strategic reserves takes time to get into supply chains, etc. So, we don't see any immediate relief in terms of prices. I would say, we've benefited. Our stock has moved up, and most energy related stocks have moved higher year to date, anywhere from 22 to 45%. So there's you hate to draw positives out of a crisis like this, but in the short term, stocks have moved higher. We're still trying to impact or assess the impact on supply chain. Certain companies' cash flows will be affected in the region, and not least, higher prices are really counterproductive in the longer term. In Europe, there's a big narrative on the renewables, and you already see countries like the UK doubling down on renewables. Part of the crisis in Europe with energy is a function of the over reliance on these renewables, and so that's not good for the region, I don't feel, and we hope that these prices come back down to more reasonable levels here pretty soon. So yeah, a very, very dynamic, very interesting period of time. As I said, we're following it daily.
Some great points you've made there. And of course, I think the tailwinds behind the energy sector already very strong, and equities were already on the rise here in 2026 before this whole debacle began. It will be interesting and potentially terrifying to see how things advance from here. But I do want to dive a little deeper into your comment about the EU, because they are, of course, facing supply disruptions for both oil and natural gas. They are dependent on LNG to a large extent, as you mentioned, and they've sanctioned Russian energy, although there's reports that they continue to buy Russian energy. They're trying to completely sanction it, and certainly they've reduced their purchases, putting themselves in a tough position. Talk to us about the state of the European energy markets at present, the challenges it's facing, and why we need more projects like yours in Europe to bring domestic supply online.
Sure. Yeah. Make no mistake, the original catalyst, the original investment of CanCambria into Hungary was almost a direct result of prices, natural gas prices moving higher on the back of the Russia-Ukraine conflict in 2022. That's when we entered the country. Certainly don't want prices really where they currently sit. Russia, Ukraine had natural gas prices considerably higher than they are at present day. But that conflict, and fast forward here, really highlights a really big dependence on imported oil and gas into the European Union, into Europe more broadly. So a little bit of kind of deja vu. The Russia-Ukraine conflict has not been resolved, and I don't know if that indicates any likelihood that the Iranian conflict hopefully won't run anywhere near as long. But certainly prices in Europe seem to stabilize. We've run all of our economics on our project on $10 gas on an MMBTU basis. I know European gas trades on a slightly different euros per megawatt hour, but we talk here on US dollars per MMBTU. Our project is economic down to $4 gas, so we certainly don't want or need those higher prices. Why are the prices high? And it's a fairly complicated landscape. Even before Russia-Ukraine, natural gas prices were moving higher. A significant underinvestment in new projects, lack of investment in existing fields as those legacy fields declined. So reserve replacement was very, very low. New discoveries were relatively modest. And then some jurisdictions in Europe moved entirely away from oil and gas and very, very much embraced net zero rhetoric and decarbonization. The UK being a good example. The North Sea is a super basin with huge reserves that have been, through policy, being taken out of the supply side. Norway, by contrast, is doing a really good job of bringing on oil and gas production. And so, yeah, there's definitely the need. Europe, the domestic production, of course, in the European Union produces about 10% of consumption. There's some industrials, heating of homes, etc. So that there is natural gas as an absolute necessity for energy transition. Some other countries are doing a better job. Turkey is one example where you have some large scale projects in the Black Sea, deep water exploration being successful. Now those types of projects are the preserve of major companies, $1 billion type projects, national oil and gas companies. So CanCambria, we find ourselves in a pretty unique situation where we can hopefully address and help offset declines, maybe even grow production in Europe. So yeah, there's a significant need for domestic production. We want to be part of that conversation.
Well, I want to help investors wrap their heads around the natural gas market here, because it's priced differently in different areas of the world, which certainly creates some confusion. So if maybe you could lay out to us the best way to think about natural gas prices, and then also the main catalysts and tailwinds currently behind the natural gas sector that you think make it an attractive investment opportunity at present.
Yeah, if we start out with an absolutely spectacular success story in North America, America, lower 48 in particular, where a lot of entrepreneurial companies, medium and small independents, got into the unconventional space. Good examples, I've worked Eagle Ford and Permian Basin extensively, and those projects either gas weighted or even the oil projects like the Permian delivered a huge amount of natural gas as a byproduct, as those associated gas. And so those projects are a good example of delivering, for example, $3 gas is kind of the average in North America, to the extent that now the US is the biggest exporter of natural gas. Probably has some impact on natural gas prices in the US for the consumer that may cause some issues. There's a lot of talk around data centers and natural gas helping to fuel some of this AI boom that we're observing. But nevertheless, a lot of natural gas moving through LNG, and that really provides a floor for gas prices in Europe, where, and of course, and to some extent Asia as well. The US is probably ranked in the top 10 for natural gas production. Three of the other areas, of course, Iran, Qatar, and Russia come in the top three. So that starts to suggest at the problem, right? The political issues, geopolitics around countries that have those main reserves and production. Longer term, it does not seem a very sound idea to take natural gas, liquefy it, transport it halfway around the world, and then regasify it. And that presents some issues itself, especially if we're looking to be, environmentally responsible, etc. Again, it's probably a good transition. But what we tend to say when we talk to our investors is energy for Europe from Europe, and that's what we're trying to address. For several years before Russia-Ukraine kicked off, Europe took for granted plentiful, affordable energy, and that changed. That's structural. That is not going to go back. Futures, looking today, natural gas was trading spot pricing on a US equivalent around $17 per MMBTU. Futures prices through the end of the year were about 16. So there's the I think that the visibility that these prices will be higher for quite a while longer until things start to settle down.
I want to now discuss how CanCambria Energy fits into the picture. You've laid out some clues as to what you're doing there in Hungary, but perhaps you could give us a more focused overview of the company and what you plan to accomplish.
Yeah, I'd love to do that. Yeah, we entered Hungary in 2022. We had a fairly aggressive 5-year plan in mind, where we entered the country. We wanted to establish a land position. We wanted to do all the due diligence and the technical work to demonstrate resource and some valuation associated with that resource, and then ultimately drill and produce oil and gas. There aren't many jurisdictions in Europe where you can do that. Hungary specifically has very good fiscal terms. We'll get into that later. It also is very pro oil and gas development. They import a lot of their natural gas, and some still coming through pipelines in the south through Turkey from Russia, some LNG from Russia as well. So, they recognize 2028 onwards, natural gas from Russia as policy driven is a no-go. So they need to find other sources of energy. As a landlocked country, they are somewhat at the mercy of transportation fees too. So in any case, we recognized as a company, a startup, that we needed to be a low cost entry. There are lots of places you could go operate in and around the world that you would need $200 to $300 million just to play the game, pick up large contiguous blocks of land. So we like the fiscal terms in Hungary. And we like the fact that we could put together a fairly substantial block of land. We currently hold around 1,000 square kilometers, translates into about 250,000 acres. We put that position together at less than $7 an acre. It comes with drilling commitments, but we would like to get busy and start drilling to realize shareholder value. Our plan, and we'll get into this in more detail, our plan is to drill our first well through the end of 2026. And bring on production in 2027, which is again back to that 5-year plan, which again is fairly aggressive, but we're on course to deliver that.
Can you shed some light on the team behind CanCambria and how you plan to leverage their expertise, starting with your own experience of value creation for shareholders?
Sure, certainly. The people are probably, the entrepreneurial mindset, the experience, having drilled a number of wells in North America, probably, the single most important factor that we can talk about at CanCambria. I'm lucky enough to have a board, a management team, and a technical team. I think we box above our weight. We're a small 70 million market cap company, but we are staffed up industry veterans that have been around, drilled many hundreds of wells all the way around the world. My background, I'm a petroleum geologist by training, educated in the UK, but spent all my time in the industry working in North America. Worked 15 years at a company called Pioneer Natural Resources. They ended up being acquired by Exxon around 18 months ago, pure play Permian Basin. And in that capacity, I was responsible for all the subsurface evaluation and then development execution of the wells within both the Eagle Ford and the Permian Basin. The Eagle Ford, kind of around 2010, we drilled in excess of 100 horizontal wells over 1 million acres. We took that asset over a relatively short period of time, this organic growth model, and the company from $40 a share to $100 a share. And that was drilling these horizontal shale wells, and then took the expertise, the knowledge, the lessons learned over to the Permian Basin. And let me tell you, there was a lot of people that said it wouldn't work in the Permian. It was a basin that had been developed for many decades with vertical wells, but a basin that had recovered probably 5 to 6% of the original oil in place. So yeah, we took that and were remarkably successful. Drilled many thousands of wells, and now that is really an industry powerhouse, a powerhouse in the US. So I'm not an explorationist. That's pretty important to recognize. I don't go into basins asking the question, is there oil and gas present? What I do, we go into proven basins. We know the oil and gas is there, and we ask ourselves, what's the best application of technology and expertise to bring those reserves commercially to the surface and realize shareholder value. So that's what we're doing. What we're doing in Hungary. One of the steps that was really, I think, instrumental in identifying this Kiskunhalas project. I spent 3 years working with a company called Ultra Petroleum, largest natural gas producer in Wyoming. They have a field there which is operationally and technically very similar to what we're trying to accomplish in Hungary. It's a field that is characterized by overpressure, a gas condensate field, vertical wells, similar sort of drill depths. And what was really critical in that field was efficiencies and driving down costs. Once the field had been initially commercialized, it was then part of the mindset here is, once you know that you have the oil and gas and you can bring it to service, how can you drive down costs? And there's no doubt Europe is an expensive place to do business. So with that in mind, I put together a team that has direct hands-on experience of drilling wells, efficiency gains, and once we get up and running with operating the field, my board is staffed up with industry veterans. You can go on our website, cancambria.com, and check out the individuals. I don't really have the time to go through each individual person, but we have an excellent operating team. We have capital markets experience. And also importantly, we have an office in Budapest. Our MD has operated and run companies over in Budapest for the better part of 25, 30 years. And there are some benefits of being over there with a presence. We have a staff over there. A lot of the filings and the regulatory things that we do have to be in Hungarian. So, there's no way around it. We employ a number of Hungarian professionals there, and we're happy to do that and be part of the European energy community. We're a part of the European Energy Council, and so we play I think a key part in leading the industry value creation and domestic production in Europe.
Over the last several months, you've put out several press releases explaining the technical understanding of the Kiskunhalas project. Could you walk us through how this translates to strategic resource development and shareholder value?
When we entered the country in 2022, there were 3 deep wells drilled in the basin. And those wells were really important for us to understand that the nature of the variability for the field. We knew we knew some of the key parameters. So we had our arms around, how large could it be? How much pay section are there in any given wells, reservoir quality, so on and so forth. So we had a good insight into the field, but none of those initial 3 wells were commercial. Now, a couple of them were drilled in the 80s when they weren't looking for low permeability reservoir, which is understandable. They tested gas to surface. A more recent well drilled in 2008 in a $3 gas environment did test over about a 6-month period, did flow gas to surface. But there was some mixed messaging between those 3 wells. There was a fair amount of variability, and we recognized early on that we would need to do some significant investment in the field to help calibrate that 3-well data set. So over the holiday period 2023 into 2024, as a private company, actually we invested around $4 million to acquire a 3D seismic survey. The technology that we leveraged then, frankly, a decade early was not accessible to a company like CanCambria. So the computing power, a lot of the wireless digital types of technologies have really accelerated these 3D seismic surveys. So we definitely benefited from that. Interpret the data, calibrate those wells, and we put in the report on SADAR is disclosed there. We help to calibrate the wells and then provide a really fairly sophisticated image of the subsurface. When we put that study together, I talked to my board and my investors, and they said, look, we spend the $4 million, how big or how much bigger does the resource get when you acquire the 3D? And I had to carry the message here that the advantage of the 3D reduces significant uncertainty and helps us move the project to a drill ready phase. But in reality, it focuses our efforts. It made the project area, geographically slightly smaller. We elevated the resource to what we call a development pending status. And so integrating the seismic with the well logs gives us around a little over a TCF of gas in place, risk recoverable in the region of 570 BCF, and well over 50 million barrels of condensate. And that type of resource can support up to 100 vertical wells. Now, when you go to our website and take a look at the investor relations deck, we present, I would say, a fairly conservative 50 well program, and even that 50 well program returns an NPV10 over the life of the field in excess of $1 billion. So we see a very sizable project. We feel that the chances of commerciality are very, very strong, especially given the commodity prices, the minimal government take in the fiscal terms. And if we are right about these types of productive wells, we're going to be right in a big way. There's significant running room. That's the important part here. Significant running room for drilling at scale over several years.
And looking ahead, what milestones should investors look out for in the coming months? How does the company plan to fund much of that operation?
Yeah, part of the story here in Kiskunhalas, in domestic Hungary gas development, those gas basins are deeper. They're deeper than MOL Group, for example, is a large $1 billion corporation in Hungary, very, very successful drilling shallow oil prospects. We actually do have, we won't get into it here, but a significant exposure to a large block of land with a lot of upside for shallow oil. it's not the focus of our conversation here today, but MOL have been successful bringing on 1,000 barrel a day oil wells in this general trend, with a similar model of shooting 3D and identifying more conventional accumulations. But back to the deep tight gas, expensive to drill. That is one of the impediments to the project, no doubt. Fairly capital intensive, especially for a company of our size. We're looking at well costs of around 15 to 18 million US. The project itself, we anticipate is cash flow positive within the third to fourth well. Current commodity prices by the third well, but we run $10 and $65 gas and oil prices within our model. So we were looking to bring in a strategic partner for the long-term development of the field, farm out a portion of our interest, and hopefully underwrite a significant portion of that initial 40, 50, 60 million outlay of risked capital. So we have a data room process which is underway. That process hopefully will conclude here Q2, and we can update the market. And so we have a lot of opportunity ahead of us. As I said, we are looking to drill our first well. We've already purchased a number of long lead time items so that once we announce the funding for this first series of wells, we can get into the field and operate. So, as I said, second half of the year, maybe September, October timeframe, drilling, production early 2027. So there are a number of catalysts here, as we step through this project. Opportunities for the stock to move, opportunities for us to get the story out there, and of course we are starting to educate our investors about this conventional oil project. It certainly won't distract us from this more strategic deep tight gas play, but we picked up a concession. We picked it up for the deep tight gas project, but it came with some significant upside that we've already had quite a lot of inbound interest on that shallow opportunity, and we're working diligently to try and characterize what that looks like too.
Is there anything we haven't yet covered, or anything you think it's important to emphasize that potential shareholders of CanCambria Energy should be focused on?
Yeah, I would just reemphasize that the timing aspect here. It's an aggressive 5-year program where we're nearing the end of that. Hopefully, first production next year. There aren't many companies of our size with the potential upside here doing what we're doing in Europe. It's actually fairly difficult to get a position within Europe. Hungary is no different. A lot of legacy positions are not turned over, so it's we're very opportunistic to pick up the position. The terms are really, really favorable. We only pay 2% royalty for unconventional production in Hungary, which is a real incentive for investment. So between the high commodity prices, between the extremely good fiscal terms, we keep most of our production for sales. Infrastructure is in place. We have a very compelling near-term story as we deliver production and shareholder value. And most importantly, we've done this before. The team has, at scale, worked similar projects. So, we're excited by the opportunity ahead of us, and we're focused on value creation at every level through the organization.
Great. Well, I'm going to put links in the description below to the CanCambria Energy website, as well as social media for people who want to dive further into the company. Paul, this has been a fantastic conversation. Thank you so much for coming on the show.
Thanks for your time, Jesse. Appreciate it.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.